Welcome to Tradespoon. My name is Vlad Karpel. I'm CEO and founder of Tradespoon, and today we're going to have our weekly strategy roundtable discussion where we talk about current market conditions and opportunities in the market and what to expect. For those of you who are new, welcome. This is my brief bio. I'm not going to spend a lot of time. Disclosures are very important. If you're new to trading or if you're new to Tradespoon, please type in new, pause the screen, and visit this link, optionscreening.com. It is important to understand the risks associated with trading stock or options. So I encourage you to look at that. That is very important. All right, so let's take a look at the market, right? We're trying to figure out what to expect next. So we do have, let's look at, so the most important is yield, I think, right? The earnings season is over. It's all about interest rates and the dollar, right? So today and after the FOMC meeting, Powell sounded pretty dovish, basically saying, listen, I'm also concerned that if we don't lower interest rates, then potentially, you know, we can have some issues with employment, right? Where the companies are in distress and they have to let go their employees, and we don't want that to happen, right? It's been already on, you know, what is it, 2 years, right? 2022, 2023, over 2 years of these elevated interest rates environment. A lot of that is coming due this year and next, and refinancing at 5% or 8% interest rate, right, on home mortgages or on loans, right, corporate debt, real estate debt. You know, that can cause a distress in the system. So you could see that he's concerned about that. So, you know, people took it as a bullish, dovish sign that basically said that interest rates are going down and GDP was revised higher, that the economy is doing well right now and still growing, and they're revising their projections higher. And 10-year yield dropped, right, below 200-day moving average, right? Pretty sharp drop, new lows, which is very positive, right, for the market. Usually the dollar moves in the same direction as the yield. This time it originally did pull back, right, but now it's kind of going back and trying to reclaim this overhead resistance. So I would watch that level. That's not good for the market, right? Stronger dollar, that's kind of a sign of a concern. So yield is going, you know, south, dollar is going north, dollar is higher, yield is lower. QQQ is broke out to new all-time highs after the FOMC meeting. It's kind of pulled back, right? Reversal, trying to close this gap, trading right on this uptrend, where it's been fighting on this uptrend. Spiders, on the other hand, had a more decisive breakout for the past 3 days, pulling back slightly, but still at all-time highs above 520. So you definitely see outperformance in value stocks, right? Where the value stocks continue to go higher, right? Whether you look at VTV, and technology is stalling, right? And you can see that in the price action of Tesla. Right, today Tesla dropped significantly, retesting year-to-date lows, and Apple retesting year-to-date lows. Right, so Tesla, Apple is still weak, and Microsoft of the world, Google, they're making new highs. But again, if you look from basically beginning of January, didn't really go that much this year, right? Whether it's Microsoft or Google. Or Meta, I think a little bit more stronger earnings. You know, since January it actually had a decisive rally. So Meta is doing good, but since February, kind of also not going very far. And then the AI darling NVIDIA, very strong performance. Obviously, from the beginning of the year, you have this vertical move up. But since March 7th, it's kind of, as it reversed, it's stolen. Right, so technology is stolen, right, trading sideways, but JP Morgan's of the world, vertical move up, you know, General Electric of the world, move up, vertical move, ExxonMobil, vertical moves up from the beginning of the year. So you do have rotation into the value stocks, right? And that continues to happen. Bitcoin, also vertical move up, similar to NVIDIA, right? Proxy for risk taking. It has been also stolen. You have a pretty sharp pullback from all-time highs at 74 back to almost 60,000. Pretty bearish price pattern. So you have mixed signals, right? Dollar is a negative signal, interest rate is positive signal. So the question is, as we approach in the next earnings season, right, and we're kind of going through these rotations, where's the market heading? Is it heading higher or is it heading lower? One second. Give me 1 second. All right, so the question is, where's the spiders heading, right? And we can look at the position, right? We've been using dealer flow as of late. So let's look at the dealer flow. So the dealer flow basically shows you how people are positioned, right? In terms of where is the highest open interest. Even if you're, I mean, I know some of you are stock traders and not option traders, but positioning is very important, whether you start an option trader or a stock trader. So I do encourage you to at least look at the positioning, how people are positioning for the time horizon that you're doing. We're talking about April, right? We're talking about going into the next earnings season where the market can go. So let's look at spiders. How are people positioning for third Friday of April, right? Where the earnings season will start. Where can the market go higher and where can the market go lower? So you can see a green line is the April expiration. And you have meaningful position, right? This is the red expires today, but the green, right? We can remove the here. So the red, pretty sizable position, meaning that at that strike price, right? At 530 strike price, you have a lot of people selling calls, right? Where they don't think it's going to go above 530 level. There are also a lot of people that are selling 540, right? 540, 545. That think that we can actually get to 540 and significant even higher positioning. But the first line of defense is 530 overhead resistance. So between 522, where are we trading right now? 520, 521. Between 521 and we could the next level of overhead resistance is 530, potentially getting to 540, right? So that's on the upside. On the downside, you have a pretty large positioning at 500 level, right? 50,000 open interest. That is the put buying, right? This is a put skew, right? Anything above 0.5 is a put skew. So somewhere between 500 and 540 is where the market is going to trade, right? Potentially 20 points to the downside, 20 points to the upside. Personally, at 500, I think this is a strong buy signal. 540, you know, I think it's a strong sell signal. And even 530, I would trim the positions. That's how I would interpret this data. All right, so these exercises are important, whether you're a short-term trader, medium-term trader, or aggressive trader, right? To kind of decide, okay, Vlad, fine, 500 is the 50-day moving average. That makes sense, right? We can go this way, or we can go that way, right? So plus 20 points or minus 20 points. Why is this important exercise, this visual rehearsal exercises? Because that's the only way you can determine position size, right? Let's say you're bullish, right? Powell is bullish. I'm going to be bullish. You know, options expiration is behind us. We're approaching the time where usually from seasonality point of view, there is a strong upward momentum. And as long as there's no black swan events, the passive least resistance is higher. So that's path number one. Plus 20 points. What could derail this rally? Where the risk? Well, the risk is what Powell said, right? Either inflation's, you know, maybe CPI and PPI data for the months of March is also going to be higher, right? Then maybe Powell is going to be, you know, he kind of dismissed the higher CPI prints for the 2 months. Not dismissed, but he said he's concerned, but that's not enough information to lower number of interest rate cuts, right? He still penciled in 3 interest rate cuts. If March comes in higher than expected, right, March data, and you have 3 data points, he might say, well, you know, next Fed meeting, he might say, listen, 3 rate cuts are off the table. We're going to only do 2, or we're only going to do 1, or we're not going to do any, right? So anything like that, right, depending on how significant that rise is and how much they change in their mind, probably could cause the market to get to 500, right? I mean, if you have few regional banks going through default, that could, you know, scare the market. But, you know, outside of macroeconomic data, companies are doing well. FedEx is up after the earnings today on 10%. So that's scenario number 1. Scenario number 2, you still have issues like Lululemon, Nike, Tesla, Apple are, you know, the growth is obviously stalling, right? They're all complaining either the problem was China, not enough demand in China, or, you know, people, you know, kind of running out of money. There's debt is too high, credit card debt is rising, and you know, yield inversion, and there's a lot of debt that's coming due this year, and you know, something might happen, right? And that's scenario number 2. So that helps you determine position size, right? If I'm bullish and I want to buy spiders and the risk is 20 points, you know, maybe 5% to the downside. Well, the point is that if I have $10,000 account, I don't want to be down more than $250. Right, so 5%. So that would be the risk. And if the risk is on the $10,000 portfolio, 2.5%, right, $250, then I know, okay, if I'm risking 20 points, well, then maybe I should buy only 10 shares, right? 10 times 20 is 200 or 12. So that same exercise, whether you're a day trader and you're looking for the next 15 minutes, or you're a, you know, swing trader, momentum trader, you may be looking at the next few months, few weeks. The exercise is the same, right? You have to go through the positive, negative rehearsal exercise, and I encourage you to keep a journal. Bob, word of the day is thankful. I think Bob made a lot of money on FedEx and Nike. Am I correct, Bob? But thank you. Yes, word of the day is thankful. I'm very grateful. First of all, that you guys waited for me. That's just very rude of me, and but I apologize. Usually, I'm on time on Strategy Roundtable Morning Bell. Yes, I'm thankful that you guys are here, and I'm thankful that you guys are listening. That means a lot to me. So that's risk management, right? So the idea of becoming a disciplined trader, right? The goal is to become a disciplined, confident trader. How do you do that? You have to have a mechanical trading, right? You have to always do the same setup, right? And repeat the trade over and over again, and always risk the same amount, right? You have to understand basically two concepts, I think, as a trader, right? One concept is game theory, right? It doesn't really matter what Bob thinks, right? Or what Vlad thinks. That's irrelevant, right? For the stock market, we're just, one or two people in the universe of millions of traders, right? But it's what's important to understand what other people think. Do they have any? Right. So basically, look at different outcomes, right? In the world of trading, right? You could be bullish, right? You can be bearish, right? Or you can be a combination of market neutral, right? So that is a very important concept to understand what other people think. And you should never be bullish all the time. You should never be bearish all the time based on the game, right? And based on the setup of trading, you want to decide, you want to figure out, which of these quadrants you want to belong to, right? So that's game theory. And the other one is the prospect theory. Prospect theory basically says that we as the humans, right, deal with our losses, right, a lot different than with our gains, right? If I made money today, I'm happy maybe for 5 minutes, right, and then I forget about it. But if I lost, money today, same amount, I will remember this for the next 5 days, right? So this loss aversion, right, in game theory is very important to understand. Why? Because how we deal with gains and losses, right? And the game prospect theory basically says if you have a choice of making, if you're in a situation where let's say you made, you're risking $250, right? We just went through that exercise on spiders. So if you're risking $250 and let's say you're bullish, right? And the market drops, right? You said 500, right? We said 500. Let's say market dropped because I don't know what, CPI came in hotter than expected second week of April, and we're at 500. Then and you're down basically $250, right? That's scenario number one. And then you have a choice to make, right? You have a choice to make. Do you, take the loss, or do you wait and maybe it will come back? It will do this one, and then you're gonna break even or even make money. The research shows that especially traders without a lot of experience, or even with a lot of experience like myself, usually we decide we wait, right? We said, 50-day moving average. Vlad said it was positioned well at 500. I'm just gonna wait, right? So, if you're presented with choice of losing $250, right? You decide to wait, right? If the market goes higher and you're up to $150, as you probably already guessed, most of us are just going to take the profits and run. The problem with that setup is that, half of the time you will make money, but half of the time the market is going to go to 480, right? There's no rule that says that it cannot go to 480. Maybe it's unlikely, but it could go to 480. Now, instead of being down $250, you're down $500. All right, so if you have a one trade where you're down $500, and let's say you have two trades where you made $250, right? You're correct 75% of the time. That's pretty good, right? well, you're just trading water, right? You're down 500, you're up to 250, right? And you just kind of go in a circle. So you want to avoid that. You want to avoid this risk aversion, right? You know, the saying is cut your losers short, let the winners, ride. Well, it's easier said than done, right? Because the way we're wired, it's different. So being aware of this is very important, right? So I encourage you to kind of understand these two concepts of game theory, prospect theory, and document your trades. And if you never down more than $250, you give yourself A or B. Some trades will be successful, some not. If you're down more than $250, then you give yourself C or D. Sometimes you'll make money, sometimes you'll not. Ernest, thank you. I appreciate you guys. Thank you very much. Okay. How do we help? Right. I think, well, first of all, I think Elite Trading Circle basically is where you can participate and trade with me every day, right? And I do different trades. Some of them are option trades, as you can see here. Excuse me. Some of them are stock trades, right? NVO, JP Morgan. Excuse me. So you have a choice, right? You have a choice. So let's look at the latest example, Nike, right? Nike announced earnings, right? We did yesterday, Bob and I talked about, and some of you also, Martin was there. We talked about, Nike screenshot, right? This is Nike positioning, right? We talked about positioning, how important it is. Basically, I said, listen, there's two outcomes. Well, there's three outcomes, right? There's three different outcomes of Nike. Nike does nothing, right? Moves within one standard deviation, right? This is distribution of outcomes. Moving 10% for Nike to the upside, right? It was at 101 yesterday. This is 10% to the downside or 10% to the upside, right? 110. This is one sigma move. If I do the bell-shaped distribution curve, this we calculated was actually, it happens, this is a 2 sigma move, right? So for the Nike, the estimated move analysis basically said it's going to move $5 to $6, right? 5% to the upside, 5% to the downside. That's, 1 sigma move, right? That's the most common outcome, that it moves only one standard deviation. 70% of the time it moves up 5%, moves down 5%. 2 sigma moves, where it moves 10%, happens very rarely, but it does happen, right? And that would be 2 sigma move, 10%. And I said that in this earnings season, right, it makes sense to be long the volatility instead of shorting the volatility. Why? Because there is a lot of exuberant expectations in the market, right? If the company says anything positive, right, especially on forward guidance and top and bottom line, they move 2 standard deviation, right? Especially if there's a word AI, like Micron lately. If they have anything negative, like Nike said that they're gonna grow in negative single digit, right? Then the stock gets punished, right? And you can see it in the price of Nike, right? So you have a 90, you have 110, and the stock, and then going back to the game theory, it doesn't matter what I think or what 1 sigma or 2 sigma, I can see a very large position at 90, and I have a very large position, almost the same magnitude, at 110. So half of the people think it's gonna drop to 90. No, actually, this is negative. People were doing risk reversal. They were selling the 90 put and they were buying 110 call, right? Because this is negative down. So I know that if Nike says anything negative, it will, not that I know, but that was my, hypothesis, right? This is just distribution of outcomes. There is no right or wrong, but basically there's a high probability or elevated probability, the right wording would be elevated probability, that on the negative news it will drop to 90, and on positive it will move to 110. Let's see what happened. And actually, case in point, you can see today FedEx, Nike, Lulu, all three did 2 standard deviation move. Nike said something negative, and they were close to 90, 91.72. It bounced back now. Lululemon said something negative. They're down 20%. That's beyond 2 standard deviation move. Right? And FedEx, something positive. Also, Bob asked me, what do I think the FedEx? I said, it could regain all-time high around 300 level. And guess what? It was at 300, right? At the after hours, it was exactly at 300 level. So positioning is very important. And then how do you take advantage of that? Well, this is nice and wonderful. So the advantage is that you can do, you can be long volatility and risk amount. So in this case, I risk 76 cents and 44 cents. So I risk $1.20, right? I risk $1.20. Potentially, the maximum profit could be $5, right? It would be $5. It's trading at $2.50. I closed it for $1.90. I think Bob is closed it for $3.50. But anyway, the point is that it's you risk under $250. I know the maximum losses, if it was 1 standard deviation move, well, then I'm down $1.20. But if it's more than 1 standard deviation move, then potentially, in this example, I made 70 cents on $1.20, 50% return, 40% return, right? And same idea was Micron, right? We did the same trade with Micron. Same thing, I bought it at $1, closed it at $4. So butterflies, iron butterflies, iron condors, this is where you can risk small amount and potentially make these 50% return, 200% return trades, right? So that's option trading, right? And you can see the setup, you can see the recordings in Morning Bell and Closing Bell. So I encourage you to do that and watch the recordings. Right, so this is where you can follow my trades. A lot of people like Bob, he's been trading for a very long time. He doesn't really need Vlad. Then we do have signals, right? What's the advantage of TradeSpoon is that my background is technology, right? I've been a CTO of several publicly traded companies in financial world, right? In broker dealers. So I've been doing this for past 20 years, building models, building IT. So that's my passion, is technology. We have a team of financial engineers that constantly building models. And lately, right, with all the ChatGPT and generative AI, there's a lot of advances in this field, almost on a monthly basis. So there are new libraries and there are new models that can basically figure out which stock can belong to which sector, to which cluster, right? And then it can apply different models all on its own, right? It does this with the AI engine, basically decides which model is appropriate. It backtests them, right? It learns on the data, it trains on the data, and then it has an inference engine where it says, okay, for Tesla, model A, for JP Morgan, model DD, right? And then it basically says, okay, out of all of the universe of stocks, these are the stocks that the model thinks is going to outperform the market. So today, let's say AMAT. Right? It's bullish on AMAT. Excuse me. And it gives you entry points and exit points. Right? It gives you, this is 1% target gain, 1% stop loss. And the idea is to use dollar cost average, right? Don't risk $250, risk only $100. So when if spiders do drop to $500, instead of being down 250, you're only down in 100, and then you have a decision to make, right? If the market condition changes, then you're out, or if this is just an opportunity to add more, then you add more. So that's active trader. You can trade it with stock. You can also trade it with options, right? You can select weekly options. Same idea, it gives you different entry points based on market conditions. And you can decide, you can trade it with weekly options, right? You can buy Delta 70, Delta 80 call if you want to leverage your account balances. You also have weekly trader, right? So same idea, just different model for different time intervals, right? Here on weekly trader this week, American Express, right? It recommended Express on basically Monday. For to buy the American Express, obviously American Express made a big rally. JP Morgan, same thing. Same thing, you do dollar cost average, but this is a weekly model, longer time interval. Maybe we want to hold it for a week, maybe 2, maybe 3. So here it's looking for 2.5% profit, right? You buy at 218 and you exit at 222, which is 2.5%. Target gain, stop loss, dollar cost average. And same thing, if you want to leverage and you want to trade options, then you can buy AMAT option. Again, delta 70, delta 80. I would suggest in the money option, and that would be this one of the suggested strike prices. So that's active trader, weekly trader, monthly trader. We talked about elite circle. If you don't want to see options, you don't want to see the word options, we do have robo investor where it's only stocks. And then we have different ways to follow my portfolio. Premium portfolio is only spreads. Spread trader premium portfolio is only spreads that you trade in, right? Once a week I provide an option spread. I think ExxonMobil was last week. And then shadow trader, you can follow all my trades. There are tools, right? Research tools, like seasonality chart is popular. Basically shows you, listen, we're entering end of March, and usually exactly at this point, you have a big rally going to the May, right? Because everybody's in a good mood. It's spring break, Powell dovish, market expanding, GDP is growing, and everybody's happy. Oh, actually, didn't forget to ask, right? So let's do one or two. Sorry, my brain is all over the place today. So how many of you say we could potentially reach 500, right? Minus 20 points, right? That's scenario number 2. We're going down to 5% in the next month and a half, or we're going up 20 points to 520. So how many of you say 520? How many of you say 500? 1 or 2? Stock sort. Thank you, Bob. 1, 2, 2, 1. All right. Wow, we do it. Half the people say 2, half the people say 1. I'm gonna go with 1. Usually I go with, lately I think the past couple of weeks I said 1. Obviously I was concerned about FOMC meeting. I thought Powell was gonna be a little bit more hawkish, that we had 2 prints, but he wasn't. Which probably indicates that he, if I have to guess, it's either the politics, right, because of the elections and there is a pressure for him to lower the interest rates, or he sees some liquidity issues in reverse repo facility or banking, right? We're gonna have audits of regional banks at some point. Those closets will be open and somebody will see some skeletons, right? It can be just one New York City bank. Right, I assume there's more New York City banks. It's just we don't know about them. When will the skeletons come out of the closet? Well, that's a little bit different, right? I have a friend who is a money manager. We had this 2-hour discussion, and we kind of said, like, I agree with you. Skeletons will come out of the closet. The question is it tomorrow? Is it in April or is it in October? Well, that nobody knows. At least I believe that nobody knows. Okay. So I'm 1, 2, okay, perfect, thank you. So seasonal chart, right, that's another one popular product. Shows you seasonality, basically, green line is the seasonality, the blue is actually what's happening right now. And you can see that continues to go higher. What else? The other product is the probability calculator. Basically, one standard deviation move 76% of the time, 511 to 532, right? So model actually sees based on historical volatility. There's some hedging at 511, right? There's some hedging at 511, not a lot, 10,000. So we could be at, 70% of the time we'll reach 511 and 532 in April. Obviously, 12% of the time we could get to 540, and 12% of the time we could get to 500. That's why I would say 500 or 540. You definitely want to buy at 500. Not definitely, but based on assuming nothing changes, if it reaches 50-day moving average, that's usually a good, strong signal, and you actually see it how people are positioned. So it looks like it will hold that level. Questions? Cash secured put on spiders. So Chuck, yes, so cash secured put on spiders, I would definitely, if that's your strategy, 500 is well positioned right now. Assuming no news, no black swan events, and CPI is not going to be out of this world, right? If it doesn't jump, from 2 to 4, I'm exaggerating, but even, if it's what they expect, 2.8, and jumps to 1 year, year over year. If it jumps by 10 basis points, 20, it's not a big deal. But if it jumps by 40 basis points, 50 basis points, well, that's a problem. But assuming you don't have that event, let's see how much money can you make on the put. Cash secured put, spiders. Let's look at that. I would go to April. So spiders are pretty well positioned at 500 level, 5% lower. Let's see how much money can you get. The VIX is low, that's the problem. Wrong date. I'm like, you can get us anything that doesn't make sense. So right now, $1. So 2%. Basically, if you do cash secure put and you can make 2% in 1 month, I mean, that's a pretty good deal, right? 2 times 12, that's 24%. Right? So, for some people say, well, dollar doesn't make a difference in my life, but for Chuck, maybe 2% a month, maybe that's a pretty good, better than money market, right? Better than money market. So, and it's well positioned. I probably would hedge at least just to sleep better, maybe 480 put, 40, but you would have to give up maybe half of the profits. So, yeah, so cash secure put 500, you can get 2%. The problem, if you want to get more, right, then you would have to go to 505, but you can see the difference. 500, I have strong confidence that that level, unless something happened in the market, it's not going to be taken out. 505, obviously a lot less confidence, right? A lot less confidence. I mean, we've been at 505 level, in March. That's March lows, right? So you could get to March lows. You just need one negative news, and we're going to be at 505 because that's March lows, right? 500, that's closing Nvidia gaps, and that's pretty well supported right now. Joseph, USO. USO. And just remember, what may be appropriate for Chuck might not be appropriate for, John or Michael or someone else, because just remember, one contract at 500, you get, not 2%. Did I say 2%? 20 basis points. $1, it's 20 basis points. 20 basis points in a month, right? That might not be enough, right? Might not be enough. I don't know why I said 2%. 2% is $10. Wait, 1% is $5. Right. So it's only 20 basis points. So scratch that. It's not 2%, right? Dollar out of a $500 stock, 1% is $5, so it's 20 basis points. I apologize. But still, 20 basis points times 12, right? That's what? 5%? 5% a year. and plus you get 5% on your money market funds, right? Because you don't have to put up all that cash. So that 5% in money market plus, additional 4 to 5%. So you can make 9-10% a year. That's pretty good, right? That's pretty good. And you're taking relatively low risk, right? But the problem is that, you have to have one contract. You have to have $50,000 in your account to be cash secure put. So if you have $50,000 in the account, you keep it. You get 5% a year. You get another 5% on selling 20 basis points every month on these at the 50-day moving average, and then it accumulates. And a lot of companies do that. A lot of institutions do. They do these structured notes. They don't sell every month. They go in a leap, right? They basically say, well, how about April of 25 or March of 21, right? Assuming 500 level holds, well, you're getting $18, right? So $18 for 1 year. This is just make sure I'm correct. So it's almost 4%, right? Almost 4%. So instead of doing every month and collecting 20 basis points, you can sell a year from now. Your break-even point is 480. You don't think it's going to break below 480. You get 5% on your cash, and you also get in, 4% on that put. And as long as it stays above that level, you can make 9% a year. But obviously VIX is low, right? When it was at 16, you would get a lot more. So maybe it doesn't make sense to do it now with a leap. You do it in months, and if it does drop to 500, you can get more premium. So USO, sorry, Joseph, USO, I'm bullish on energy. Crude oil has broken out of this range, broke above this downtrend and above the 80 level, staying above 80. I mean, it's pulling back, retesting this uptrend. So I would wait, right? This is this downtrend. I mean, it did broke above that, it's staying. So I'm still bullish. I think oil is going to, I mean, it's a dollar story, dollar kind of going higher. So oil pulled back. But it's above 200-day moving average. It's above the 79 level. I think crude oil is going higher. And I mean, USO is a derivative of crude oil. Above 104. Thank you, Chad. BJ, yes, it is surprising. We have to figure out, why is yield precipitously dropping below? But that makes sense because Powell is bullish, dovish. Why is dollar not dropping? I mean, it could be Japan, right? With their yield control, right? This is like a multi-decade low, right? For the Japanese yen, and dollar is very strong, right? So maybe that's giving a boost to DXY. How's the euro doing? Euro is kind of trading in the range. So it's a stronger dollar could be the carry trade, right? Because right now, I think Sweden or Switzerland, I think Sweden, they already started lowering interest rate. So right now the perception that, Europe is in recession and they're going to lower interest rate a lot more aggressively and sooner than the US will. So then you have this carry trade and the dollar goes up, right? That could be that carry trade, right? Because nobody knows who, it's a race, to the bottom now. So then that could be and that's probably one of the reasons the dollar is stronger. But that's not good for the equities, right? Strong dollar is usually not good for equities, for commodities. Chuck, thank you. All right, any questions? BJ, Bob, Chuck, Ernest, Ian, Jim, John, Joseph, Kevin, Coffee, Martin, Michael, Oren, Patrick, John, Michael, Steve. All right, it's 10:31 again. I apologize for being late. Thank you for waiting. I really appreciate this. I mean, I would watch a dollar, right? But we've seen these divergences before, especially with the carry trade. That doesn't mean that the market is going to sell off. I mean, if the dollar jumps above 105, that would be problematic, right? So I would watch this overhead resistance. That would be problematic. 10-year yield dropping, that's bullish, right? Lower yield, that's good. TLT finally looks like catching a bid and rising, trying to reclaim 200-day moving average. That's positive. Values at all-time high. QQQ is near all-time high. Semiconductors almost regaining their all-time highs. Small caps are expanding. I mean, you do have this short pullback, but very strong rally on the low interest rates. 50-day moving average was held successfully. You do have broadening of market participant. All of these signs are bullish, right? All of these signs are bullish. There are obviously areas of concern, right? But going back to the game theory, that's not at the forefront of the discussion right now, right? Whether regional banks will or will not default, whether we're going to have another Lehman moment, that's not at the forefront of traders right now. If we do have signs of some kind of distress beyond, New York City Bank, then, we get back to the whiteboard and look at it. But for now, VIX is very complacent. There's no fear in the market, and people are very well positioned at 500. So that's very supportive for the current market. All right, you guys been great. Thank you very much. Have a great day. Bob, how did you do on FedEx trade? Were you able to close it? All right, have a great weekend. I'm gonna be traveling. Monday, Tuesday, Wednesday. I'm visiting my daughter. She's to study abroad in London, so I'm super excited. So I'll be in London. So we will not have a closing bell Monday and Tuesday. So there's no closing bell Monday and Tuesday. And you guys all like Scott. So Scott will do the morning bell on Monday, Tuesday, and Wednesday. So I will see you guys either today at closing bell or on Thursday morning. Thank you. The market, nice, Bob, very good. Yeah, PDD was a good example. Joseph, thank you, very nice. I'm glad it worked out, Bob. Thank you. All right, have a great weekend, everybody.